Most people think that valuation model in investment banks are built using lot of historical data and fancy templates. That is going to be true for bulge bracket banks, which work with lot of publicly listed companies. But 80% of investment banks don't work that way. They are going to work with private companies, small and medium sized enterprises, or family businesses, which do not have lot of data available. In this video, we are going to understand how boutique and mid-market investment banks build valuation models for these private companies with limited data, aggressive growth assumptions, and real client workshop. Hey there, my name is Karan Damania. I'm an ex-investment banker turned founder, and through Encoding Careers, we help you crack into investment banking the right way. So let's get onto the screen and start understanding how valuation models are created in boutique and mid-market firms. Alright, so when we mostly talk about not building valuation models using historical data or going through financial statements, most of the people have question in mind, then what's the method? How do you actually create a valuation model without going through history? That is what exactly we are going to look. But before that, you must understand why you must learn this style of modeling. If you're someone who's going to break into investment banking without having a Tier-1 MBA experience and wants to start out into investment banking after their graduation or having any professional certification, then it becomes very difficult to directly get started into a bulge bracket where the historical data set models are created. And bulge bracket are only like 20% of what we see in investment banking industry. 80% of investment banking roles are working with private companies which do not have these kind of historical data. So here the analyst requirement that these investment banks are going to have will be someone who can build VC style models, because the transactions that are going to get facilitated through this investment bank are mostly venture capital transactions or small mergers and acquisition, where you don't have lot of data for these companies. Here you are not going to do historical analysis. Most of the model will be based upon growth, logic, market sizing, and the scaling projections that you have taken. And trust me, if you are able to build this kind of model, you become immediately valuable to boutique and mid-market investment banking firms, even if you don't have an MBA, which is fine for these companies because you can get started with the skills that you have. So this kind of modeling will be very important. In this entire video, we will understand the framework as to how this entire model is created. If you want to understand every step as to how this DCF valuation model is structured, then you can check out the previous video where we answered the question, walk me through a DCF, which is most important for an investment banking interview. So in this model, you will get the framework and you will get an insider as to how these firms actually work and create valuation models. So for that, we have these 5 steps that we are going to cover. What are the challenges with private companies, then difference between the bulge bracket and boutique models, then the 2 steps that we are going to cover to create these models. One is the client workshop and validation, then VC driven models, and finally the summarizing all of the 4 steps that we have covered. So starting with the challenges with private companies, financial data is very sparse, unaudited, and irregular. Because these private companies are caught up in their operations, they are not very structured, because most of them are either family owned businesses where it is transferred from one generation to other, where the generation does not want to work onto the business exactly, but they are just doing it for the sake of doing it, and there's not a lot of proper maintenance of data, or the management team is very caught up in operations and they don't have a lot of time on managing financials. So there could be a lot of reasons, and that is where you don't have exact information on the financials that are maintained by these companies. So as a banker, you will first have to do a lot of understanding of the business model. What are some of the line items that can be taken from here to there, and that way you will first structure the models for these kind of companies. Then market comps are also imperfect or missing. Since these private companies can be operating in a very small niche, getting exact market comps for valuation range will be quite difficult, and compared to public limited companies where you are doing historical based analysis and you can easily prove what you have taken into your projection down the line. Here in private company, it does not work that way. You will have to do a lot of client workshops to validate assumptions, because both the client and bankers both have to be aligned on the vision as to where they want the business to go. So these are some of the challenges, and due to that, there is difference between the bulge bracket models and the models that are created in these small investment banks. Hey there, are you trying to build your career into investment banking but not sure if you are right fit for it? Then you can check our investment banking fit assessment, where you get questions across 5 different sections core to investment banking, and then you are going to get a score at the end which will help you understand your fit for the industry. If you want to go through it, then there's a link in the description which will give you access to it. It's free for all, so make sure that you try it once and assess your fit for the investment banking. Thanks for going through this side note. You can continue with the video. The major differences are, for bulge bracket, you have a lot of publicly available comparables. There is large data sets. You have annual reports available to read the business model, to understand how they function, what is the market share that they have, how much are they trying to capture down the line, with a very good management who understands the business very well. So for creating those kind of models, you easily have a lot of data But yeah, definitely it is quite complicated because the business is quite expanded. You have to understand the business first yourself, and then you can create these kind of detailed model. In terms of boutique banks, you don't have a lot of data available. The business is small, but first you have to structure these data. You don't have metrics available, so you have to create good metrics for yourself, and the assumptions are very bespoke. So these assumptions will be very, very related to the business itself. The framework can be the same, but the numbering that goes into it would be quite different. Due to this, the models are quite research heavy for boutique banks and require a lot of client validation, because you need to align on the vision that you are going to showcase through your model and the story that you are going to project. Here's the overview of the 9-step valuation process that can be used to create valuation model for any kind of company. It could be listed company or it could be a non-listed company, private company, as we are talking about. So first you're going to focus revenue, then you're going to start on the expenses part, which will help you create P&L. Then you'll structure the balance sheet. Finally, the cash flow statement will close on the financial model. And then you're going to start on the valuation part by calculating cost of equity, projecting free cash flows, calculating terminal value, doing a sensitivity analysis, which will help you get a range of valuation. And that is how you can pitch it to the stakeholders who need these valuation models. If you want to understand this in detail, we've covered in the previous video itself, where we walk through each of the 9 steps in detail with a template of valuation model also. And if you want to learn these valuation model building, you can get enrolled for the investment banking mentorship program, where we personally train candidates to learn these kind of valuation model, which helps them get started into the small investment banks. That is the 9-step valuation process that is used for creating these kind of valuation. And the most important thing that we have talked in the difference between a bulge bracket and boutique models is that they are not trend based. So you are not analyzing the previous trend, but you are going to create a story around what the future holds when we expand our business. So private value company valuation is not like valuing a listed stock. You cannot rely on historical trends, clean audited statements, stable growth patterns. We have already discussed upon this when we started out. So here you will have limited data, irregular financials, rapidly evolving business models. As of now, the business might be only operating in a particular state in India. 3 years down the line, they might be expanding to 20 other states, 30 other states, or even starting to export. That is how that rapid evolution of business model has to be showcased in your financial model, and that will show a very good growth rate that is going to get capital for your company. So you can't apply the 5-year historical growth as your future growth logic. You will have to study the business, and you will have to sit with the clients to understand what is the business model they are projecting down the line. So as discussed in this particular slides, model are research heavy and require client validation. So these are 2 points that we are going to cover now. This kind of valuation model building needs a lot of client workshops and validation. Giving you a walkthrough whenever a client gets onboarded, if and let's assume they are going for a fundraising round, it could be a series B round of funding. Currently the client is having some kind of revenue coming into the business. They might be having good structure of the financials with them. But now, when they expand their business and they want to raise funds, they are going to go to a VC, right? Series B round of funding are mostly covered by a venture capital firm or small institutional investors. Now, these kind of rounds, when they are done, the investor is not expecting that they are going to grow at a 20% growth rate for the next 5 years. They want exponential growth rate. So here, when we talk about exponential growth rate, it could be 10x, 20x in the next 5 years, in the next 7 years. That kind of assumptions have to be created, and for that a lot of client workshops are done and a lot of validation has to be done, because you cannot just show anything into your model. It will be questioned by the investors. If you don't have a right answer for it, then the funding round can be hampered. So in the client workshops, you as a banker host a lot of workshops to understand the growth plans, to understand the pricing, the hiring, the capital expenditure that they are going to do, and all of these inputs are then taken into the model that you are going to create. As a banker, you have to be very, very smart in asking right set of questions. How are you going to reach X amount of users in the next 12 months? What is the team that we are going to hire? What are the core pain points as of now? How are we solving those core pain points? How will the operating team, marketing team, and the management team? Very, very specific questions have to be asked, so that you get answers from the client as to what they have their plan in their mind. And you also start discussing those assumptions with your seniors who are there into the industry from 20 years, 25 years. They also have seen a lot of businesses grow from 0 to 100, and they can therefore leverage their knowledge how to grow a business and give you right direction as to what you need to input in your model. So that is where you are asking very focused questions and structuring your model, and there will be a lot of updates that the model will need. So sometimes these updates will be from the client, sometimes these updates will be from seniors, and you have to be very proactive in doing these changes in the model, because when a client is suggesting you something, it means that they have those thought in mind and they are going to stay with that particular output when they are in meeting. And if you have not showcased those output in your in the model that you have created, then there will be misalignment. So it's very important to stay proactive, immediately apply whatever changes are being discussed, and that will be building trust in you also, that you are someone who is very active in taking action upon things, and that way you have high chances of getting the transaction done. That is the first part of how models are created in boutique firm. You are doing a lot of client workshop and validation. It does not work on the same way for a bulge bracket, because you are using your expertise on how the industry trend is looking like. You research a lot about the market comps, and that is where you are figuring out a range for the valuation. You are not doing a lot of client workshops, growth plans, or hiring or capex, because that is already been done by the company, and there might not be a lot of changes in the next 5 years or next 7 years. It might be a slight change, and that depends upon the industry that they are catering. All right. So hey there, since you are there into this video up till here, just wanted to let you know that if you're serious about building a career into investment banking, then you can check out our 2-hour free investment banking masterclass that covers a lot of things about investment banking, like lead to deal conversion, the ultimate hierarchy, what are the skills needed for investment banking. It's free for all. Just go to link in the description and you can find access to it. That is the part one. Next, we have most important part about VC driven models need big defensible growth. As we discussed earlier, that when we talk about pitching it to a VC, right, they are not looking for 10 to 15% CAGR growth rate. Now, VCs are someone who take a few bets in a particular year. So if a VC has 100 crore of assets under management, that is the cash at the start of the year, they might decide that they are going to take 5 crore bet at 20 startups. And from these 20 startups, they know that 5 to 6 are going to give negative returns, 5 to 6 are going to give neutral returns, 3 to 4 are going to grow at 15 to 20 percentage, 3 to 4 are going to grow at 100 or 200 percentage, and 1 to 2 might be growing at 50 to 100x, and they are looking at this 50 to 100x opportunity in every startup that they are evaluating. And if you want the transaction to be done by your investment bank, you have to showcase those kind of growth rates in your model as well. So they expect 10 to 30x potential over the next 5 to 7 years, and if your assumptions do not justify those growth rates, then the transaction cannot be facilitated, right? Because it does not match their criteria. This is the reference of the model that we teach to our candidates for investment banking, and here these are the revenue projections that is done via case study, and the company here is going for a series B round of funding. We can see that the year 1 projection of revenue is showing 26 crore, and in year 5 we are showing that we are growing to 394 crores. That is almost 12 to 15 times growth in our revenue. And this does not mean that the profit is also growing 12 to 15x. The profit is going to grow multifolds, because this is just a revenue. Initially we are going to be in loss. When we talk about the year 5, we are going to definitely turn profitable. So if we come to profitability, we can see that initially we are negative 15, then we are going to grow positive 16 percentage. So it's negative 3 crore to positive 65 crores. That's almost like 200x growth in the profitability of the business. That is the amount, that is how the growth rate should be done, and it should be very, very logical and backed with a lot of research. That is how the VC driven models have to be showed, which should be defensible. Alongside that, when you create these kind of growth assumptions, it shows that you have deep understanding of revenue engines, like how are you going to expand. You also understand strong unit economics, because you are going to model out and focus upon every line item of financial statement. As you are not doing historical analysis, no element is coming from what has been done in the past. You are definitely going to refer those things when you project for future. You are not taking only the historical data for reference. You are giving a thought process to it and doing a lot of planning and processing. So that is where strong unit economics comes into the picture. Then you are doing a lot of market sizing, like what's the current market penetration that we have and how are we going to grow into it. And then clear path to scale. Scale is something that VCs are looking out for, and you have to be very good at showing it. So if you master this thinking, every other type of financial model becomes easier. So trust me, if you know how to model out for these small investment banks, then you can easily leverage the framework that is going to be used over here, and you can easily create a model for a listed company. You have applied a lot of logic, you understand the business model very well. You are not just doing historical data analysis. You are going down into revenue engines, you are going down into unit economics, market sizing. The outcome for that is you can model out any kind of businesses. So that is about to approach. First, you have a lot of client workshops, research to back your model. From that backing, you are going to create models that are very fit for where you are going to pitch it. So most of the time it will be VCs or the acquirers. Summarizing the points that we covered in the previous slides, when we create private company valuation, it is going to be research plus client validation, and you have to tailor it for investor type. It could be VC and private equity. And for creating this valuation model, you are going to use the 9-step process, which brings a lot of backing to the scarce data that these private companies have. And when we do these workshops, the assumptions turn into investable projects because it is going to be backed by a lot of planning and plotting of things as to how are we going to achieve these things. All right, so that is the summary. That way we conclude this video. If you want to understand this 9-step valuation process, do check out the previous video and you will have detailed understanding about how these models are created. If you are able to build valuation models as discussed in this entire video, you will become a valuable asset for investment banking, because this is how deals are closed when they are pitched to venture capital or private equity players. And 80% of deals that happen in this investment banking industries are not related to publicly listed companies. If you are someone who wants to start into investment bank without an MBA, then this is going to be very important for you. So if you found this video valuable, do like and subscribe to Encoding Careers for more such videos. And also let us know your suggestion or recommendations for upcoming videos on the channel. So that is it for this one. See you in the next video.